Yeah, good morning, everyone. Good morning, everyone. Just you can log off. Am I audible?
Yes, sir.
Okay, before I start, one quick important announcement as far as your IA is concerned. I think Prag sir has already floated the timetable on your WhatsApp group, right? I, I hope you have seen that particular timetable.
Yes, sir.
So you will have altogether,
Yes, sir.
okay, 30 questions, out of which you have to answer any 25, right? Per question will carry around 2 marks. So altogether, you will have a paper of 50 marks. Now, for investment management that I'm doing, mostly it is theory. But when it comes to problems on taxation, okay, you will have problems in taxation wherein 4 answers would be given to you. You will have to solve that particular problem, and then you have to tick any one of the 4 answers. This is how the evaluation is going to happen. It is going to be an online test. Time would be given to you. After a certain time, no answers will be accepted. So please make sure that you have adequate internet connectivity. If you want, you can recharge your data packs and see to it that you don't have any hindrance when it comes to answering your IA tests. Is that okay? Now, whatever I complete till today is there for your exam. Okay. Whatever I complete for tax till tomorrow would be there for the exam, right? So let us start with this particular subject of investment management. Yesterday, I showed you this particular graph. Okay. I told you how the market moves and what are the things that happened in the market over the last 15, 20, 15 years or so. What has happened in the market, you can clearly understand from the arrow marks, that have been marked in either red or in green. The green color marks indicates that the market is moving in a positive direction, whereas the red color mark indicate that the markets are crashing out. So these are different phases that we have. Now, before I move forward, there are 2 new terms that I would like to coin. First, whenever markets go up, we call it as a bull phase. Whenever markets go up, it is always called as a bull phase. And whenever markets come down, we call it as a bear phase. So we can experience bullish sentiments in the market, or we can expect bearish sentiments in the market, right? So depending on this particular situation, we need to analyze this particular market. What I'm doing right now is I'm explaining you to the concept of market risks, right? So in market risk, I told you why we need to study market risk is basically we have to classify the risk into two heads. One is systematic risk and another is unsystematic risk. Systematic risk is not under your control. Okay, it is not under your control. Even if you have not done any mistake, you still have to experience this. Okay. Now, for example, take the example of the present pandemic that we are facing. Okay, because of somebody else's mistake, the entire world is paying a price for it. So this the entire system is got affected by it. So what type of risk that the world is facing? The world is facing a market risk because of somebody's mistake. Okay, or because of somebody's greed, the entire world market had comes to a standstill in terms of job losses, in terms of income losses, in terms of business losses, in terms of life and property loss also. So the entire system failed, or this entire people were affected, the entire population of a particular area or region were affected because of somebody else's mistake. So you have to suffer along with others, because even though you are not made anything, still you have to suffer. Why? Because you are in a system, and because you are in a system, you have to face this particular risk, which we call it as the systematic risk. The first type of risk that we face is called the market risk. And when I was explaining you to the market risk, I explained to you that there are different phases that happen as far as the market movements are concerned. And whenever, if even if you are a good investor, okay, even if you are a good investor, suppose you had invested somewhere here and the markets were here, even if you are a good investor, because of somebody else's mistake, okay, you also have to pay a price, you lost your money, right? So these phases keep on happening, these ups and downs keep on happening, and that is where the entire market is going to face a risk. That's the reason we call it as a market risk. Next, whenever market moves, it always moves in four phases. There are four phases wherein the market also moves up. Okay. Now, what is this 200 MA? Don't worry about it. I'll explain to you when it comes. But always market moves in four directions, or it has four phases. The first phase we call it as an accumulation phase. Okay. Generally, it is a phase wherein a long run phase. Generally, you can see the trend for over 6 months or so. No, the market, you cannot decide the direction of the market. Neither the market is going up nor the market is going down. So it is moving in a horizontal manner, right? So this phase we call it as an accumulation phase. Okay. After the accumulation phase gets over, there will be a sudden dip. Once the accumulation phase is about to get over, there will be a sudden dip, and after that particular dip, the market starts moving in the green line. That means it starts moving in the upward direction. We call this as a bull phase or the advancing phase. Okay, you might have heard a term called as breakout. Breakout means, can you see this line here, dotted line? Can you all see this dotted line here? If you observe this
Yes,
particular,
sir.
if you observe this particular pattern, the graph has never crossed the upper limit nor the graph has crossed the lower limit. But if I extend the line here, if I just extended the line here, you will see that there is a breakup. That means it is, this black line has touched the lower limit and then it has taken a bounce back. We call it as a breakout. That means it is breaking out from that barriers and moving in the opposite direction. So we call it as a breakout from accumulation phase. Okay. So we have the upward movement here. Okay, this upward movement continues to in a particular direction, and after that, okay, after the accumulation phase is over, then we have another saturation phase. This we call it as a distribution phase. Okay, again, look at this time. This is 6 months accumulation stage. This is 6 months distribution phase. Okay, in the distribution phase also, if you can see, okay, there is a sudden breakdown, and then the market moves in a particular direction. Neither it crosses the above level nor it breaks the lower level, but it moves in a horizontal direction, and then all of a sudden, we have a decline stage. All of a sudden we have a decline stage. So these are the four different phases in the market. If I have to just mention to you, doesn't it look like a product life cycle? If you just overall look at the pattern, doesn't it look like a product life cycle pattern? On your x-axis you have time, on your y-axis you have the growth, the introductory stage, the growth stage, the maturity stage, and the decline stage. Can you identify those four patterns here? The market always moves in this particular direction. Now you might be wondering, what is this 200 MA? 200 is 200 days moving average. So they take 200 days moving average. Now why did to take 200 moving days? Is because how much is 6 months? 6 months is 180 days, right? 6 months is 180 days. So if you take 6 months average, they have a calculation called as 200 days moving average. So they take a moving average, and based on that moving average, they come to know in which direction the market is about to go ahead or about to head in that particular direction. Same way here also is a 200-day moving average. Here also we can see 200-day moving average. The same is observed in the 200 days moving average. So if you look at this, 6 months plus 6 months plus 6 months and plus 6 months. So altogether this life cycle is of 2 years. So market to take any one direction, it takes around 6 months. To go in one direction, it takes 6 months. To stable in that particular market, stable in that particular situation, it takes 6 months, and then again we can have a decline of 6 months. So this is a time frame of the market. Clear? Now my question is, where are we right now? My question to you, all of you, is where is India right now? Are we in this particular stage? Are we in the advancement stage? Are we in the distribution phase? Or are we in the decline phase? Don't take only pandemic into consideration, but take the overall view of last 5 years and say, tell me, where in which situation are we? Are we here, accumulation stage, advancing stage, distribution stage, or the decline stage? Think and tell me.
Say advancing.
Advancing. Why? See, investment management is a very bad subject. If you say yes, you have to answer. If you say no, still you have to answer. So now you have said advancing. Please tell me, why is it advancing?
So because economy is developing.
Economy is developing. Okay. How did you come to a conclusion that the economy is developing? How do you know that your GDP is increasing or economy is increasing? How do you come to know this? Rohit need not answer alone. Others can also answer. A very, very simple tool to know whether the economy is advancing or the economy is reducing. Any answers? Quickly tell me. If you don't know, if you tell me don't know, we proceed. We'll not wait.
So like India is exporting different goods and services to different countries.
Okay. Agreed. Okay. My solution is very simple. I'm telling you the time frame of last 3 4 years. Not only, don't consider this pandemic. It will get over in another 6 months also. But take a view of the long term view of around 5 years. Honestly, tell me, and don't answer me. Answer it to yourself. When you go for shopping, do you bargain? If you go for shopping, do you bargain? Point number one. Second, has your pocket money increased in the last 5 years, or is it the same? Has your living standard remained the same, or it has increased? Are you spending more money than what you used to spend in the last 5 years? If your answer for this particular question is yes, that means we are increasing. There is more income that has been generated. There is more wealth being that has been generated, and that is the reason we can come to conclusion that yes, per capita income of every individual is increasing, right? Per capita income of the people is increasing. the number of people who are moving above the below poverty line is also increasing, which means there is a good advancement, okay, as far as the economy is concerned. So don't worry about stock markets and other things. Just look at your own example. Has your pocket money increased in the last 5 years? Has your living standard increased in the last 5 years? Right? Do you bargain when you go for shopping? If your answer is no, that means you have money in your pocket, right? So if you answer all these questions, they are very basic questions. If you answer all these questions and the answer to your question is yes, then we are advancing economy. Whereas in some countries, okay, they are in the same way, whatever was their income in the last 5 years, the same income they have, the same distribution pattern, the same disposable income they have, the same per capita income they have, okay, whatever they used to bargain, at the same level they are bargaining. So what are they are into the distribution phase. That means they are distributing money, equal division of money is happening, right? And of course there are some countries who are in the decline stage, some countries who are in the accumulation stage, so these phases will keep on happening, right? But what I'm trying to tell you here is, depending on the situation that you are in, we come to know easily in which of the four phases we are presently moving in. If you are moving in the any one of these phase, okay, if you are moving in the advancing phase, definitely the entire economy, in sense the entire nation, is also moving in the same phase, right? So we can come to a conclusion that we are now in a advancement stage, okay, and very soon, probably in 5 years, or yeah, around 5 to 7 years from today, we will reach a stage wherein we will come into a distribution phase. But till that time we will continue to grow at a in the second phase, that is advancement phase. Next, as I said, uh, market risk has to be clearly defined. Market risk is defined by a person called as Jack, okay, Clark's Francis. Okay, he has said that if you want to really know whether the market is moving, whether if you really want to know the market risk, look at the direction in which the market is moving, right? Look at the bull market and look at the bearish market or the bear market. Now, what happens in a bull market? In a bull market, there is constant upward movement in the trend line. That means this market always moves in the upward direction. Okay, the trend is always on the higher side. Okay, we get a there are some points that we call as peak at crest. Okay, it's a stage of euphoria and enthusiasm, and then after that, that becomes a bubble burst. So this particular phase, we have a bull phase. I think the other day I showed you which is a bull phase. I'll just repeat it. Okay, in this particular diagram, when the market crosses this point, the horizontal line, from this point up to this point, okay, we call it as a bullish phase. I don't call this as a bullish phase. I don't call this as a bullish phase because we are in a recovery phase. This is a relief time that we get. So we are in a recovery phase. But from the point the market opens up from this point and goes till this point, we call it that we are in a bull market. Constantly there is a upward movement in the market. I will show it to you practically in the segment here. Can you see this phase? After that Black Monday, whatever happened, after the Black Monday, that whatever happened, okay, this is a threshold line. The markets have constantly gone up. Of course, there were 1 or 2 points that went down, no doubt about it. But overall, the markets have started going up. So this is what we call as the bull phase. In fact, they say that this type of a growth is not an actual growth. The actual growth has to be in this way. It has to go up, then come down, again go up, come down, again go up, come down. No, this is the actual phase of, this is how the stock market should actually grow. This is not the way the stock market should grow. Clear? Anyways, but we still experience this type of a growth. But if you look at from this point, okay, the we call it as 2061. Can you see this mark here, 2061? So 2061, from this point, the market went up to a very high segment. It moved up to the highest level, that is 6,150 almost. So this is what we call as the bull phase. So there is a steady upward movement for a significant period of time. From a low level, the market moves to a higher level. There is peak at crest. So you found out there is a peak that is getting attained, and after that, the market starts falling. So this is a stage of enthusiasm and euphoria. In this particular stage, any Tom, Dick, and Harry will also make money in the market. So you need to understand that whenever any Tom, Dick, and Harry are making money in the market, that means you should get out of the market. The markets can fall anytime. Okay, so this is that particular stage. Next, we have a bearish market. In a bearish market, the markets are constantly falling down. The Sensex moves from a higher level to a lower level. Okay, the lowest point it reaches, and that point we call it as a trough. Okay, so one is peak and second is trough. It is a stage of panic post bubble burst. So things start going in a different directions. Things don't start working according to your wills and wishes. Then you can understand that we are moving in a opposite direction. Clear? Yeah. Then there are some factors that affect the stock markets. The major factors that affect stock markets are tangible factors and intangible factors. So we'll see what are tangible factors that affect the market. Okay, these are events which have a materialistic value. That means they can be counted in monetary terms. Okay, and because we are able to count in a monetary term, we call it as a tangible aspects. Now, what are those things that happen in India? Let us see one by one. Okay, primary forces for for affecting the stock markets was the Pokhran blast. Remember this date? I think most of you were born in this particular time. Okay. The Pokhran blast took place in this particular year, 1998. All of a sudden, what happened? People panicked. The entire world panicked. They said, "How can India make a nuclear blast without the knowledge of America? Okay, or without the knowledge of any country? How can India make a nuclear blast? And that too, not two. India made 5 nuclear blasts, right? So all of a sudden, there was a shocking wave that was sent in the market. And what happened to that? The markets fell down immediately. Okay, the markets fell down immediately. It fell down by 162 points. This was a major fall. Then when the news reached America, America said that we are not going to help you in any ways. That means no financial aid will come to you. Okay, so you have to live on your own. This was a time when Atal Bihari Vajpayee was the prime minister. And once Bill Clinton, who was the American president, he said that we are going to impose sanctions on India. He called all the businessmen in India. Atal Bihari Vajpayee called all the businessmen in India and said, "This is a golden opportunity for you. If you have got the technology from America, now they have stopped supplying materials to India. No, disintegrate their technologies, study those technologies, and you develop your own technology and expertise in that particular subject." So as a result, after that, the Indian manufacturing sector was given a major boost. So this was one of the points, and that is the reason the market fell down. Immediately when US imposed sanctions, US told its companies that operate in India, they told that you leave India and come out. Okay, when the US government told American companies to leave India and come out, what happened? Whatever American companies that were there in India, they started selling their assets. So they started selling in the market, and as a result, what happened? When you have too much of selling, what happens? The price falls down, and whenever price falls down, people start getting panicked, and they also start selling their assets. So this is a stage wherein the entire market got affected. What was the reason? Just the Pokhran blast. So one Pokhran blast took place, and the entire market started falling down. Okay, then if I have to give you today's example, what happened? Remember, around 2 months back, not exactly 2 months, around 45 days back, India and China had a tussle at the Bulhan border in Ladakh. Right? There was a problem at the border between India and China, and as a result, around 20 Indian soldiers were martyred, and around 40 Chinese soldiers were also, they lost their lives in that particular tussle. Because of this particular tension that grew between these two countries, major countries, what happened? The entire stock market of the world crashed. Why? Because if these are the two very powerful economies, growing economies, if they start fighting among themselves, the markets are definitely going to react to that particular information, and they are going to fall down. So whenever you are able to estimate a material value to whatever is happening, that force we call it as a tangible force. On the other hand, there are some intangible forces also. Something is happening somewhere in the world, and you don't know why a particular thing is all of a sudden going up and going down. For example, if you might have observed in the last 45 days, all of a sudden Gold that was trading at somewhere around 35 or 36,000 rupees per 10 grams had reached 53,000 rupees per 10 grams. I think you have all noticed this. Now, many people did not understand why all of a sudden the gold went up. There was no marriage season. People coming out and mixing with each other was not there. People did not have money to buy gold. Then how all of a sudden price of the gold shot up? Okay, nobody knew the answer for it. So when you don't know why a particular thing is happening and because of what reason a particular thing is happening, such forces we call it as intangible forces. It is basically psychology. Now exactly I'll tell you what happened in that particular phase. People thought that investing your money into share markets is not a lucrative investment opportunity now because the tension between these two countries is increasing day by day. One. Second, we are not able to control this particular pandemic, which is going beyond control. So money as such, the currency that we have, will not have any value in the days to come. So if currency does not have value, what else will have value? It is the gold that is going to have value. So what did people do? They sold their assets in terms of shares, mutual funds and bonds, and they whatever money that they got, they purchased gold for it. So all of a sudden, the gold prices started shooting up. Clear? So always remember this. Whenever stock markets fall down, the bond market and gold markets always go up. And whenever gold and bond markets fall down, stock markets always go up. This is the inverse relationship between bond markets and stock markets, gold markets and the stock markets. So we exactly don't know for what is the reason why a particular thing is happening, but it is happening. Okay. So in such cases, we call it as an intangible reaction or an intangible event that affects the entire nation. Clear? One such thing that was found out was way back in 1994. We did not understand why all of a sudden people have started buying, the FIIs, heavy buying of FI. For what reason? We did not understand till today. But people purchased. Why did people purchase so much of FIIs? We still don't know, but it happened. Okay. So these are called as intangible assets or intangible events that affect the stock markets. Any doubts in this particular slide? Okay. Now we can see here very well what is Nifty bull and bear chart. Can you see the red line here? Can you see red line? No, look at the dates. I am putting it from January 2007 to June 2013. Only in this particular 5-6 years I am putting the chart out. Can you see this particular fall? This is global financial crisis, 2008 crisis that started. So look at the market. It was somewhere here. It was somewhere around 6,000 points in this particular phase. Now it started coming down. So red mark that you can see is what we call as the bearish phase. The market starts falling down in a very bad way. Then this is the lowest possible level that it reached. We call this as a panic stage. Okay. Up to this particular level, we call it as a relief stage. Okay. From this point to this point, we call it as a relief stage. And once this stage gets over, then we have a bull stage. Okay. So the green line, overall green line that you can see is a bullish phase that we experience in the market. Okay. And then I'll just show you the dates here so that you'll be able to understand. Just look at the dates here. Recovery started way back in March 2009, and from 9 to almost November 2010, this was a phase wherein we had a strong recovery in the economy. Then we had another major flaws. Okay, this was a time when the second UPA government was in power, wherein policies were delayed, policy paralysis happened, decisions were not being made quickly. There was a lot of delay in making any decisions. So as a result, what happened? Inflation started coming in. Inflation started coming in. No, there was slowdown in the GDP. We still had global recession, and that is the reason the economy, it neither went down nor it went up. There was a stagnation stage that the market achieved. Clear? So this is a phase that I wanted to show you, just because we can clearly see a bearish phase here and we can clearly see a bullish phase here. plus we can see some consolidation. Consolidation means economy not taking one direction, either up or below. It is not taking any one correct dimension. Okay, just a minute. Clear with? So whatever we discussed so far is what we discussed only about the market risk. Now we come to the interest rate risk. Now understanding interest rate risk is a bit complicated. I will give you a simple example so that you will be able to understand what is interest rate risk. Okay. Let us suppose who is here? Okay, let us say Tanas is here. Okay, and there is Akshata. These are the two people who are operating in the market. Now, both of you, please pay attention. Akshata and Tanas. Tanas, you have purchased a debenture. Okay, you have purchased a debenture which has a rate of interest of around 10%. Okay, please make a note somewhere. What is happening here? Okay, Tanas, please make a note somewhere. You have invested, let us say, 10,000 rupees in a debenture, okay, for next 5 years at a rate of interest of 10 years, at a rate of interest of 10%, right? So,
Yes.
Tanas, can you calculate what is the yearly interest that you receive? Can you quickly calculate what is yearly interest that you can receive? Tanas, are you there?
Yeah, hello.
Yeah. What is 10% of 10,000 rupees? You need a calculator for that.
1,000.
rupees, right?
Hello, sir. Yes, sir.
Per year, how much interest do you get? 1,000 rupees,
Yes, sir.
right? Okay. So this is your situation. This is your investment. You are receiving 10,000 on an investment of 10,000 rupees. You are receiving yearly 1,000 rupees as a interest. Fair enough. We have Akshita here. Okay. Now, Akshata also wanted to invest her money, but she did not have time or she did not have money at that moment of time. 6 months later, now she has around 10,000 rupees for investment, but she cannot invest into that debenture because that offer is over. On the other hand, I have one more offer for her, and that offer is you invest 10,000 rupees. Okay, you invest 10,000 rupees and you will not get 10%, but you will get 12%. Okay, Akshita, you will get 12%. What is 12% of 10,000 rupees? What is 12% of 10,000 rupees? Akshita, are you there? Okay. Rohin, can you do the calculation quickly?
1,200, sir.
Okay. Rashmi, are you there?
Yes, sir, I'm there.
Rashmi, you have also invested in 10,000 in a debenture worth 10,000 rupees of investment. The rate of
Yes,
interest
sir.
is 8% for you. What is 8% of 10,000?
It is 800, sir.
Okay. Now we have three interests. Tanas with 10%, she is earning 1,000 rupees. Rohin with 12%, earning 1,200 rupees, and Rashmi with 8%, earning 800 rupees. If I say that I am ready to issue another debenture, but the rate of interest is now going to be 9%. The rate of interest now is going to be 9%. So hereafter, whatever rate of interest that you have, will not be 12%, will not be 10%, will not be 12%, will not be 10%, will not be 8%, but will only be 9% uniform. Okay. Now in such case, Rohin, can you think? Do you think your debenture, will somebody buy your debenture now? Rohin, do you think somebody will buy your debenture? Are you able to get my logic here?
Sir, please can you repeat? It's a network issue, sir. Can't.
Okay, I'll explain it to you in a very simple way. Quickly tell me. We have three people.
Yes, sir. Yes, sir.
We have
Yes,
three
sir.
people, Tanaz, Rohin, and Rashmi. Okay. Now, I'll make it more simple. Let us say all of you have invested 10,000 rupees at 12% each. Take a simple example, 12% each. So how much are all of you getting? 1200 rupees every year.
Yes, sir. 1,200.
Fair enough. You invested this money for 5 years. Okay, and you're happy with your investment. Next year, I'm the same company where you invested. Next year, I come up with an offer saying that I need more money. Okay, and those who give me money in the form of debenture issue, I will not pay them 12%, but I will pay them 14%. Clear? I will pay them 14%. I have
Yes, sir.
issued debentures worth 12%, wherein Rohin is a holder of it, Rashmi is a holder of it, and Tanaz is a holder of it. But I'm not happy with this 30,000 rupees of money. I need some more money, so I issue fresh debenture. And to attract more investors, what do? Instead of giving a rate of interest of 12%, I will give them a rate of interest of 14%. Now, quickly tell me, when I'm issuing debentures worth 14% in the market, will your debenture have value? My question is to Rohin, Rashmi, and Tanaz. Will your debenture have value?
So it will affect, sir.
Yes, your answer is correct. It will affect. Why? Because
Affect. Yes, sir. Because the rate has increased to 12 to 14.
Yes, the reason is, even if you want to sell your debenture in the market today, nobody is going to buy it because they are already getting a debenture at 14% rate of interest. So why will anyone come to you and buy
Yes,
a
sir.
debenture at only 12%? They will feel that I am losing 2% if I purchase the debenture for you. On the other hand, if I take the debenture from the company itself, I will earn more money. Now, because of this, because of the change in interest rate, what has happened? Tanaz has got affected, Rohin has got affected, and Rashmi has got affected. Is it your mistake? It is not your mistake. It was a policy that the government made, or the policy that the company made. And because of this, you also got affected. Why? Because now your debentures, nobody is ready to buy it, because it is earning a lesser rate of interest. On the other hand, I will keep the debenture rate same for you, for all three people. But the new debenture that I'm offering, I just make one change. The new debenture that I'm offering, I will offer it at 10%. Okay, I will offer the debenture at 10% because I cannot afford issuing debentures at 12%. I can afford 10%, so I will issue debentures at 10%. Now what will happen? You three have a debenture worth 12%. I am issuing debentures in the market only at 10%. Will your debentures have more value in the market or less value in the market?
Our debentures have the value, sir, 12%. 10% will no.
Yes. So your debenture value will increase all of a sudden. Why? Because the fresh
Yes,
debentures
sir.
are at a lower interest rates than what.
10%.
So whenever such things happen, when the investor gets affected because of the adverse change in the interest rate, that particular risk, we call it as interest rate risk. Getting the meaning for this? So whatever I explained is available in those 4 to 5 points. That is there. That is what you can see on the screen. Are you able to get the example here? The rate of interest that you are earning. Okay, if the company issues a bond which is higher than your rate of interest, then you will get affected by the rate of interest. So you lose your money. And that is the reason when you lose your money, you are going to face a risk. This risk, we call it as the interest rate risk. Getting it? Any doubts here?
Yes, sir. No,
So
sir.
can you please repeat it, sir? I just missed